Good morning. This is John McFarland with Miller Johnson's Trust and Estates Practice Group. Welcome to this morning's webinar. Today we are going to discuss charitable lead annuity trusts. Interesting time right now with interest rates as low as they are. The June Section 7520 rate is 0.6%. In May, it was 0.8%. And the Section 7520 rate is set by the Treasury every month, and they look at interest rates across the board and they come up with that recommended rate. And that is important for purposes of CLAT planning. We'll talk about what a CLAT is, what the characteristics of the CLAT are, the tax benefits, and the mechanics of how they operate. But right now, with everything that is transpiring in the economy, with low interest rates, we had a drop in the market here yesterday. If there's an opportunity for appreciation, that's always a good time to consider CLAT planning. And if there are low interest rates, that's a good time to consider CLAT planning. And then also, we are in a time from a tax policy standpoint where we have very high lifetime exclusions for gift and estate tax planning purposes. The current exclusion in 2020 is $11.58 million per person. So a married couple can combine their exclusions and exclude over $23 million in estate taxes. So that is a tremendous opportunity for tax planning purposes. We tend to see CLATs utilized by individuals who are facing taxable estates. So right now, those types of clients are not as prevalent as they once were. When I first started practicing as an associate in Chicago back in 2000, the estate tax exemption was $675,000 per person. And now in 2020, we're at $11.58 million per person. So that's a substantial increase. And because we have high exclusions, not as many people are facing taxable estates. But for some people, the CLAT is a tremendous opportunity right now. What is it? Well, Charitable Lead Annuity Trust. So the name itself is helpful in determining how it operates. The lead interest here is the charitable interest. So a charity receives a payment for a term of years from a CLAT. A lot of people refer to CLATs as mini endowments for a charity. They receive a fixed payment for a period of years, and then upon the termination of the CLAT, the remainder interest goes to children, family members, sometimes charitable remainder trusts. So the lead interest goes to charity, the remainder interest goes to children or family. It's the reverse of how a charitable remainder trust works. With a charitable remainder trust, the charitable portion is the remainder interest, and the lead interest there goes to the unit trust income beneficiary. So just a little bit different variation of a type of charitable trust. It is important to when considering CLATs to realize that transfer taxes play an important role in CLAT planning. And you can transfer significant wealth to children with a CLAT. And the reason is it's freeze technique, much like other freeze techniques you might see in the estate tax planning context, like a sale to an IDIT or a GRAT. The CLAT is a freeze technique. So at the time the assets are transferred to the trust, the valuation is frozen in terms of estate tax for estate tax purposes. And so anything that in terms of appreciation above that section 7520 rate, which is in June 0.6%, any appreciation in the trust above and beyond 0.6% in June will pass free of transfer tax to the remainder beneficiaries. Typically, that's the children. So a tremendous opportunity if you think about it. If you can, in your trust portfolio, return 6-7%, everything above 0.6% is going to go free of transfer tax on down to the remainder beneficiaries. So great opportunity in periods of low interest rates. And on top of that, that low interest rate also, when you are calculating the present value of that lead interest, which passes to charity, that low interest rate is going to produce a larger gift tax deduction when calculating that present value of that income interest. So that's a tremendous benefit as well when you're operating in a low interest rate environment. It's also possible, and I'll talk about later on in the webinar today, you can get an income tax deduction with something that's called a super CLAT or a super grantor CLAT. You invoke the grantor trust rules, and you are able to get both an income tax deduction and a gift tax deduction. So tremendous tax opportunities here, tax saving opportunities. Just a very powerful vehicle and technique to use for transfer tax purposes, for income tax purposes. Just a tremendous opportunity. Usually what you'll see with these CLATs, it will be a combination of stock, cash, and real estate that are oftentimes used to fund these. And a good example, say there's a piece of real estate that the client or donor owns, and maybe it's on the edge of town or in a area where the zoning might change, and so you know the value of that parcel is going to appreciate significantly over time and in the future. Well, if you put that real estate in a CLAT and also include some stock and cash, you can use the liquid assets, the stock and cash, to pay the lead interest to the charity. And then upon the termination of the CLAT, you can pass that real estate on to the remainder beneficiaries. And the goal is that that parcel would have appreciated in value, and you get all of that appreciation down to the remainder beneficiaries, the children, and out of the estate of the client donor. So that you're usually trying to include an asset that is going to appreciate, or there's potential for great appreciation within the CLAT. And that is a goal, is to get that asset on down to the remainder beneficiaries with limited exposure to transfer tax, sometimes in certain cases with no transfer tax. You can leverage your lifetime exemption, and I'll show you how that is done. But the exclusion, the exemption, the $11.58 million exemption, through planning, you can really coordinate things in such a way that it's a powerful planning technique where you're getting the most possible out of that $11.58 million exemption amount. And you'll see here in these examples I have lined up just how that is handled. I'm going to throw this out there. This is a webinar audience challenge I'm going to put out there. And these numbers are extreme, I'll admit. I have never helped someone set up a $336 million CLAT. Someday I hope that happens, but I have not done so yet. I've worked with clients and donors on some substantial CLATs, but I wanted to use that number so you can see the power of this vehicle and how you can move significant sums. So let's say you're a development officer or a plan giving officer, and you have a donor walk into your office and he says, I have a spare $336 million that's just burning a hole in my pocket here. I need to do something with it. I have 11.58 million in lifetime exclusion remaining. And in the next 15 years, I want to make gifts to charity. I want to transfer more than the 336 million to my children, and I don't want to pay any transfer taxes. So is that possible? Yes or no? So, well, it sounds impossible. It certainly doesn't sound like a reasonable request by this gentleman, but let's see if we can make this happen for him. This is a non-grantor CLAT. And so if this gentleman were to place $336 million in a CLAT, he gifts that $336 million to the lead trust, he would receive a charitable tax deduction of over $240 million. Now, why does he receive a $240 million gift tax deduction? Well, this CLAT, the way it's structured, has a 15-year term. So for 15 years, that CLAT is making payments to a charity. And the first year income in this example would be $16.8 million. So $16.8 million times 15 years, the total charitable payments in this scenario, it's going to be $252 million and some change. And the present valuation when using the IRS formulas for calculating that gift tax deduction would be, the deduction would be over $240 million. So that reduces the taxable gift of $336,115,860 down to $95,729,158. So you reduce the taxable gift significantly from that gift tax deduction available because you're making that lead interest gift to the charity. After the trust terminates, then the family is going to get $609 million. Nice to get a nice gift like that if you're the remainder beneficiary. But this is based on a 6% capital appreciation. Ordinary income of 2% is assumed in terms of the projections here. So, you know, when you're dealing with that type of money, you can make a lot of money. And it increases quickly there. So you're going to have significant growth transferred down to the children. You see on the right side in that column there, $273 million is transferred, and it saves over $109 million in gift or estate taxes. So you look at, 40% gift taxation and estate taxation. This is pretty powerful. Now, obviously, most people aren't dealing with these types of numbers, but if you're dealing with someone with a taxable estate, there's tremendous power in this vehicle in moving wealth down to children. So that's something that to keep in mind when you're dealing. Sometimes if you're working with the nonprofit, or you're an executive for a nonprofit, or a development officer, plan giving officer, CLATs might be appropriate to discuss with board members. Many times board members for charities, they're going to have assets or wealth. Some of them will have assets or wealth in this that are going to involve taxable estates, and this might be a good presentation to make to a board of a charity. Now, you still have $95 million here in a taxable gift. So that we accomplished the goal. The gentleman's request was he wanted to make gifts to charity. Well, he made the gifts to charity. He got more than the $336 million down to his family. He got $609 million to his family, but he still has $95 million in gift tax. So that's or a taxable gift of $95 million. So that's not, we didn't accomplish that goal. Well, let's see what else we can do. Maybe we can do something else to bring down that taxable gift value, so we make this gentleman's dream come true. Another alternative here, and this is really exciting. I've been doing a lot of this type of planning lately, and my colleagues at Miller Johnson, we've been doing a lot of these because of these low interest rates. You can combine a family limited partnership or a family limited liability company with a CLAT. Why would you do that? Well, if you contribute an asset to an FLP or an FLLC, you can suppress that value. You can take a minority interest discount or a lack of control discount, and the valuation, say the asset initially is, going in, fair market value will be 10 million. Well, if you combine it, if it's in an FLLC or an FLP and there's a minority interest discount or lack of control discount, you can suppress that $10 million value. Sometimes, you can get, I've seen discounts depending on the appraisal, you can get it between 15 to 30% discount. I've seen some higher than that. So you do have to get a qualified appraisal, and it needs it can't be obviously inflated, or you're going to get audited and get into trouble. But these are out there and available, and it reflects the fair market value of the asset when you incorporate those discounts. So that suppression of the value, pushing it down, helps in this planning, because that means the gift tax liability will not be as significant, because your valuation going in is lower. And then the lead interest to charity, which we saw on the previous slides, that allows for a gift tax deduction. So if you're suppressing the value going into a CLAT and you have a gift tax deduction because you have a lead interest going to charity, you're going to reduce the transfer tax liability. You're going to reduce the gift tax liability. So we'll see here. This is what is sometimes referred to as a double discount lead trust. Now, why the double discount? Because you are pushing down the value, suppressing the value with that lack of minority or lack of control in the minority interest discount, and also you're suppressing the gift tax liability because you have a large gift tax deduction from that lead interest to charity. So here, that $336 million that man had just hanging around for CLAT planning purposes, if we were to put that into an FLP or FLLC, and we're able to get a 25% discount, valuation discount, the discounted value going into the CLAT would then be $252 million. So we're pushing it down from 336 to $252 million. Well, what does that do? Well, that, with the deduction, the $242 million deduction for that lead interest present valuation, that reduces the taxable gift from $252 million down to $11,580,000, and that is the available amount of this gentleman's lifetime exemption. So that is an example there. Now, this is an extreme example, I know, but I wanted to point this out. If you can reduce the taxable gift down to the remaining exemption amount of the client or donor, in this case, the gentleman had $11,580,000, he can fund this CLAT, file a 709 gift tax return, utilize that remaining exemption, and not pay any tax in structuring this. So you'd be surprised, and I see this often, people with significant wealth do not utilize that exemption during their lifetime. Now, they should for tax planning purposes. Not everybody wants to do it, but from a tax perspective, you want to utilize that during your lifetime. Make gifts because you get appreciation out of your estate by doing that. A lot of people don't want to part with money, and I can understand that. But from a tax planning purposes, perspective, it makes a lot of sense to make full use of that exclusion during your lifetime. So here, for 15 years, if you had, now I based this on, I've changed the payout percentage on the CLAT to 6.67%, because that, with the suppressed $252 million trust value multiplied by 6.67%, you get the same income of $16.8 million, and I wanted to achieve that. So in 15 years, you get $252 million to charity. After the expiration of the 15 years, you have, so the suppressed value here in the right-hand column, that $457 million amount, that is the discounted value, taking into consideration the 25% discount. Now, not taking that into consideration, you see up top $609 million. That's the value that the family is going to receive when you're not taking into consideration a minority interest discount or lack of control discount. So suppressing the value going in, utilizing that gift tax deduction, you get the double discount, and then you move that money on down to children. So tremendous and powerful technique here. But on this slide, I wanted to show you that 11.58 million, you reduce it down, and then you use that exemption. You leverage the exemption to make this transfer of wealth. Great planning technique. The CLAT is a taxable trust, so it's not like the charitable remainder trust. You can put assets in a charitable remainder trust and sell them inside the trust, and you don't trigger the gain. Here, if you sold an asset within the trust, it's going to trigger the gain, which you don't want to do. Most people don't want to do that. So, if you have real estate or something that's going to appreciate, you don't want to sell it inside the CLAT. You want to use liquid assets to pay the lead interest, like the cash or the stock, and leave the illiquid asset alone and allow that to appreciate. That's usually what transpires with this CLAT planning. But what do you do at the end? You have this appreciated asset, so you have appreciated real estate with a low basis. Well, what you could do is at the end of the CLAT term, have the remainder beneficiary of the CLAT be a charitable remainder unit trust. And so when that appreciated asset goes into the charitable remainder unit trust, the trustee of that CRUT can sell that asset without triggering the gain and diversify the portfolio, which would in turn generate more income for the charitable remainder unit trust income beneficiaries. So that's sometimes that's called a tandem trust concept, where you combine the CLAT and the CRUT to soften the exposure to gain for that CLAT asset coming out of the CLAT. So that is a technique which is used. In fact, I've done that with clients many times. The super CLAT. This is, I believe it was Conrad Teitel, a very famous charitable tax planning and estate planning attorney, came up with this concept. And really what it is, for purposes of estate taxes, the trust is going to be excluded from the estate of the settlor, taxpayer, donor. But for income tax purposes, it's going to be taxed to the grantor, which you say, well, why do you want that? Well, if the grantor pays income tax and the trust doesn't pay income tax, then it's a cash burn, and that grantor settlor is reducing his taxable estate by paying the income tax. And he's allowing the assets within the CLAT to grow without having to be eroded by income tax payments. And so because of this, you get an income tax deduction and a gift tax deduction, which is really a tremendous combination there. The way that you invoke these grantor trust rules is that typically it's the 675-4 power for a non-adverse party to reacquire trust assets. And that goes into trust. That's part of the trust drafting and planning, but that's what allows for the income tax deduction to be available and for the income to be taxed to the grantor. So a very powerful technique there as well. These CLATs are really popular right now. We are getting a lot of interest from clients that are setting up significant sized CLATs, not $300 million CLATs, but some very large CLATs. And it's great for charity because charity gets, if it's a 10 or 15-year term payment on a CLAT to a charity, that's a tremendous gift. And it's just a great vehicle to use to benefit charity, to reduce transfer tax, reduce income tax, just a very powerful vehicle that you want to utilize during periods of low interest rates. And if you have questions about CLATs or something you'd like to discuss further with me, please let me know, and email me or call me, and I'd be happy to talk to you about that. I wanted to point out also our Back to Work Resource Center. This is a great resource that our employment team has put together, and there is just a great deal of information there, forms, plans, policies, all available if you sign up and gain access to this. If you are an employer and you're confused with all of the executive orders and the rules, this is a great resource that could help you work through all of these issues. Our website as well has some great client alerts, webinars on all of these issues related to COVID-19, employment-related issues, business issues, tax planning issues. So I'd encourage you to take a look at that. And I want to thank you for your attention this morning. Again, please call me or email me if you have questions about Charitable Lead Annuity Trust or philanthropy in general. Be happy to talk to you. Thank you, and appreciate your attention. And that is all for today's webinar. Thank you.